We talked about the general concept of accounting and some of the rules of financial statements. Now we're going to dive right into the statements themselves and cover them in two different sections. A lot of times we talk about the aspect of posting things. Historically, it's always been into books. Nowadays, our books are always electronic for the most part. That said, probably the most famous out there is called QuickBooks. Plug that in your QuickBooks. It's kind of the accounting software, but nowadays we have a lot of different things coming to market, and we'll see even more with the advent of artificial intelligence taking its role now in the world of accounting. We'll see many, many, many different kind of changes. The three financial statements, as I mentioned previously, balance sheet, income statement, and the statement of cash flows, and you have to know the fundamental accounting equation. If you notice, I had to drop my voice whenever I said that because all accountants know that you have to know the fundamental accounting equation. It's assets equals liabilities plus owner's equities. You have to know this. You have to know it for the class. You also have to know it for the general business aspect. If you're reading something, you'll see assets, liabilities, you'll see owner's equity. You have to know what these are. It's critical, and it's always balanced that way. And of course, like simple algebra, assets minus owner's equity equals liability. Assets, you have the whole thing on the equal sign as well. But for the most part, we refer to it assets equals liabilities plus owner's equity. This is critical to know, especially for the balance sheet. It really looks as to what you have for assets and liabilities and owner's equity. Those are actually major headings right inside the balance sheet. Every business, from the teeny tiny business that handles the dog's grooming all the way to General Motors, they all have to have a balance sheet. And here you want to look at the things that you own. We call them assets. So keep in mind, assets are things that you own. So you'll have a lot of things, anything of value that's tangible, things that you touch, or intangible, the things that are intellectual property and untouchable. So assets. And then the other terminology when we talk about this is the liquidity. How fast can you dispose of it? And if you can dispose of it instantly, you sell it. Like cash is certainly easily to do whatever you need to with it. It already is fully liquid. But that said, if you have a building is hard to get rid of. So it's the much slower liquidity, and it takes time period. So we talk about current assets, we talk about fixed assets, and then we talk about intangible assets. We have three categories of assets. So current, things that we can liquidate within a year. You can convert this into cash in a year. A desk, a chair, you can sell that. You may not sell it for all its value, but you can certainly sell it within a year. A building, a 20-story office structure, it may take 2 or 3 years to actually liquidate it, to actually go through, because that's a fixed asset, permanent land, building, and equipment. So that's a different category. So current assets, fixed assets, and then you have the three areas we call the intangible assets. For example, patents, trademarks, and copyrights. They don't have a physical form, but they have value because you can sell them for cash. We call those intangible. Three categories: current, fixed, and intangible. They're all assets, and you know that assets are things that we own. Liabilities are things that we owe. Assets own, liabilities owe. And then what the business owes to other people, and then the common liability counts, kind of just like assets have three different categories. We have three of them also for your liabilities. You have accounts payable. In other words, here's an account you owe somebody money and you're going to pay them shortly. We call that your current liabilities involving money. Notes payable, which are short and long-term liabilities, and then bonds payable, which are long-term. So they're all based upon timing as to how soon you pay them. Accounts payable, a lot of times that's 30 days and less. Notes payable, sometimes it will exceed up to a certain date, certainly always less than 3 years. And then you have bonds payable. And what's left over is called an owner's equity. It's the amount the business belongs to the owners minus any liabilities owned by the business. And you can also have earnings, and you can retain the earnings in the business, or you can end up distributing it at certain time periods as dividends to the shareholders. To retain it, you keep it inside the business, and you may want to plow it back into expanding your business. So your key financial statements, your balance sheet, we refer to it as a picture in that moment in time. Because if you have an account that says cash, one day you may have money in it, and the next day it may not have any money or more money or less money in it. It is a snapshot on the day that it is done. We tend to refer to the next statement here about shortly, the income statement as a movie, but for here on the balance sheet, it's a snapshot. The fundamental accounting equations, assets equals liabilities plus owner's equity. Assets, things you own. Liability, things you owe. Owner's equity, whatever's left over. Liquidity is all about how fast you can actually sell it and get money for what you have. And retained earnings are the things that you keep. These are all terms you have to know to fully understand your key financial statements. Take care.